and 250,000 came from if you don't tell it. See, I'm trying to give you partial credit, but I can't if you just throw numbers out there and say, figure it out. I mean, I can't do that. I've got to map it out so that you can follow what I'm doing. So now I take 1,425,000 plus 0 plus 240,000 and divide by 1,050,000, 1,300,000. And when you do that, what do you get?
128.
128. So there's my answer. Remember, to be right, your answer's got to include a dollar sign and 2 decimal places. Now, did I answer your question, Ms. Williams, about dilution test?
Mm-hmm.
Questions? About anything from chapter 16?
Our answer has to be that format.
Has to be a dollar sign, and it's got to be 2 decimal places. Yes.
I mean, like the whole fraction.
No, but to me, this makes perfect sense. I mean, this is what you're doing, right?
Mm-hmm.
So why not put it in that form?
Oh,
But if you want to do it some other way, as long as you get the right answer, but you can't then come back and say, well, you said we could do it a different way. As long as you get the same answer, I'm fine.
Okay.
This just makes perfect sense to me, because this is exactly what you were doing methodically. Questions? Okay, is chapter 16 going, gone? All right. So let's look at chapter 17. This one is accounting for investments. Okay? First of all, these have got to be, in this chapter, marketable securities. And what do we mean by marketable securities? That means they have to be readily traded on an exchange. You have to be able to determine the market value. And the only way you can do that is if they are publicly traded. Okay? There are 2 types of marketable securities. They are debt investments and stock investments. Debt investments can fall into one of 3 categories. They can be trading securities, available for sale securities, or held to maturity securities. If the bonds are classified as trading securities, they are reported on the balance sheet at fair value, with unrealized gains and losses reported as part of net income. Net income on the income statement. If you classify your debt investments as part of available for sale securities, they are reported on the balance sheet at fair value, with unrealized gains and losses reported as part of
Comprehensive
other comprehensive income in the stockholders' equity section of the balance sheet. OCI as part of other comprehensive income in the stockholders' equity section of the balance sheet. If you classify debt investments as held to maturity securities, they are reported on the balance sheet at amortized cost with no recognition of unrealized gains and losses. No recognition of unrealized gains and losses. Okay. Secondly, we have stock investments. In this, we need two brackets going out from them. 0 to 20% and 20 to 50%. If it's 0 to 20%, the proper accounting treatment is called what? The fair value method. If it's 20 to 50%, it's typically referred to as the equity method. But remember, instead of it being the percentage of ownership, what is the deciding factor in whether we use the fair value method or the equity method?
The influence?
The ability to exercise
Influence.
significant influence. That's the key. Significant influence. If the investor can exercise significant influence over the investee, then you have to use the equity method. If not, then you use the fair value method, and the unrealized gains and losses are recognized where? In income. For stock investments accounted for under the fair value method, all unrealized gains and losses flow through net income. Net income. Yes.
Okay, just for clarification. On the test, you're going to specify whether they have significant influence or
Yes.
not. Okay.
Because you can't know that otherwise.
So we shouldn't assume that they have some significant influence just based off the percentages.
Okay, if you're told 25% and you're not told anything to the contrary, you should assume equity method. Yes.
Okay.
So in this chapter, you need to be able to prepare journal entries related to adjusting these things to fair value. And remember, the journal entry needs to tell me, where are you recognizing this adjustment? Is it in income or in equity? You got to tell me that. That tells me that you know where it goes. Don't just tell me fair value adjustment and then unrealized holding gain or loss. Okay. Is there anything else specifically in chapter 17?
Can you do a problem?
Sure.
Problem 7.
Problem 7.
It's the one with the accrued interest.
Okay, these are debt investments now. These are not equity investments. These are debt investments. Investments in bonds.
Okay. Well, can we do that whenever we get to it?
Well, I'm there now. You want to do it? Problem 7?
Yeah.
Okay. But you just said equity investments, and I'm going you to know these are not. These are debt investments, investments in bonds. You didn't say equity. Okay, I misunderstood. So problem 7, I'm on page 957. Prepare the journal entries you consider necessary, including any year-end entries, assuming these are available for sale securities. Available for sale securities. All right, so here we go. On February 1, the company purchased 10% bonds of Gibbons Company, having a par value of $300,000 at 100. That means we bought them at 100% of face value, or at par, plus accrued interest. Interest is payable on April 1 and October 1. All right, so there's two different ways we can do this, and both of them are acceptable for GAAP purposes. Okay? The first thing we're going to do is debit debt investments. AFS. We paid 100% of face value, so that will be $300,000. Okay, skip the next line, and I'm going to credit cash. The question is, how much did we pay? All right, so I'm going to put a little asterisk there, and I'm going to put an asterisk here. We bought $300,000 bonds that we paid 100% for. So we paid $300,000. We know that part. Then we got to figure out how much is the interest. 300,000 times, didn't it say 10% bonds? And how long has it been since these bonds last paid interest? If you're sitting here on February 1 and the bonds last paid interest on October 1. So it's got to be October, November, December, January. 4 months. Right? So this is 300,000, and then 30,000, 1/3 is 10, 310,000. So that's how much we pay. Okay, now, your book likes for you to have an abnormal balance in an account just until these bonds next pay interest. Remember back in chapter 14 when we were issuing bonds between interest payment dates, we had an abnormal balance in what account back in chapter 14?
Interest revenue.
Interest expense, right? In this case, you're on the other side, you're buying somebody else's bonds, so for you, it's interest revenue. So they would say, debit interest revenue, $10,000. Revenue is a normal credit balance. So this gives you an abnormal balance in this account. Are you with me? Your Gleim book does it a different way, and they would say you should debit interest receivable for the same $10,000. So what I'm going to do is debit interest receivable, or tell you you could debit interest revenue. But whichever you do, that will make the next journal entry different. If you did it one way, it'll look one way. If you do it another way, it's going to look different. You with me? All right, the next date says on April 1, the semi-annual interest is paid. Okay? Talking about those, oh, I'm sorry, I should go over here. Debt investments, AFS securities, and I have 300,000. Okay? Now, if we did it with the debit to interest receivable, what would the entry look like on April 1? Debit, cash. 300,000 times 10% times 1/2 of a year. So that's 15,000. Okay? What would we credit?
Interest receivable.
Interest receivable. 10,000. But now your journal entry doesn't balance. But haven't you earned some interest for the month of October and November? I'm sorry, the month of February and March. So do this. 300,000 times 10% times 2 12s. What's 1/6 of 30,000? 5,000. So that would be interest revenue, 5,000. Okay, now, what if you had prepared the original entry with a debit to interest revenue? What would that journal entry look like there? Debit cash, 15,000, and credit interest revenue, 15,000. So then, interest revenue would have been a debit of 10 and then a credit of 15, so it'd be a credit of 5, right? Well, what is it now? A credit of 5 and interest receivable is gone. How are we doing? Are you with me? Okay. On July 1, (9% bonds of Samson Inc. were purchased. The bonds have a par value of 200,000 and were purchased at 100 plus accrued interest. Interest dates are June 1 and December 1. And these bonds have a face of 200,000. Okay, so now you tell me, which way, since these were also issued between interest payment dates, which of these do you prefer to do? Debit interest receivable or debit interest revenue? Receivable. You like interest receivable better? Okay, well that's what we'll do. So now we're going to debit debt investments dash AFS securities, 200,000. Debit interest receivable and credit cash. Again, I'm going to put an asterisk here and figure out how do we determine the amount of the credit to cash. Well, first of all, $200,000 bonds that we paid 100% for, and then $200,000 bonds times, what's the interest rate on these bonds? 9%. And these bonds last paid interest on June 1, so we're only a month later. So 1/12. So 9% times 200,000 is 18,000 times divided by 12 is 1,500.
Yes.
So 201,500. $201,500. Therefore, 1,500 is the amount of interest receivable. Are you with me? Then number 4. On September 1, bonds with a par value of $60,000 purchased on February 1 are sold at 99 plus accrued interest. So we go over here to, I forgot the date, September 1? So bonds having a par value of $60,000. And it's these first bonds, the ones we bought on February 1. So we know we got cash because we sold bonds. We're probably going to have a gain or a loss, right? And since we sold them plus accrued interest, we need to recognize some interest revenue, don't we? So skip a line, and I'm going to credit interest revenue. And I'm going to credit debt, investments, AFS securities. Well, I already know how much that's going to be. It's $60,000. Okay? So now let's do the hard part, if you ask me. Let's figure out how much cash we got. 60,000 times 99%. You sold them at only 99. You paid 100. But you sold them for 99, so you're going to have a loss. All right? Now we got to figure out how much is the interest that has happened. These bonds pay interest at 10%. And when was the last time these bonds paid interest? On April 1, right? So April, May, June, July, 4 12s. Well, let me go back. Last paid on April 1, April, May, June, July, August. You're right. Oh, how I missed that up. 5 12s.